Welcome, fellow traders, to Leaf Algo Academy, where we bring trading education crafted by experienced traders for all traders to grow their knowledge. My name is Ben, and today we will be diving in to the all-important stop loss, why they are important, and several ways to set them. So if you're ready, let's dive in. But don't forget to hit the like and subscribe buttons so you never miss out on future content. So before we dive into the how to set a stop loss, first we must understand the what and the why. So what is a stop loss? A stop loss is a risk management tool used by traders and investors to minimize their losses in trading. A stop loss is a predetermined level, right, at which a trader will exit their position, ensuring that their losses are limited to only that level. Stop losses are essential for maintaining discipline, which discipline is what really sets apart the long-term successful traders from people who, end up blowing up their accounts, or, they may get lucky on a couple trades, but really it boils down to luck. You got to be able to protect your capital. So that leads into the why. Why do we have a stop loss? Stop losses are crucial because they prevent us from making emotional decisions. So, say a trade goes against you and you don't have a stop loss, you're going to be wishfully thinking that the price is going to come back up past where your stop loss could have been, and putting you into profits. And the reality is that's probably not going to happen. And you need to be able to protect that capital so that you can live to trade another day. So now that we understand what a stop loss is and why it's important, I want to jump into 5 different ways that you can easily set a stop loss and protect your capital. And these are ways that anyone can do. Um, they're not very hard, but they are so critical and so simple. So let's dive into that next. So the first method I want to look at is a percentage-based stop loss. So these are the calculations for how you would formulate your price point, which would set your stop loss. So in the case of a long stop loss, you would take the current price of the candle that you're opening on, minus the current price times that preset percentage that you're willing to risk. And for a short stop loss, it's the inverse of that. You would take the current price and add that price that is the current price times the percentage. That would give you your stop loss if you were going short. So let's take a live, not necessarily a live example, but a real life example. If you were a channel trader or a breakout trader, you would see this nice channel here on AVAX. But let's say you are a conservative trader and you are going to wait for the breakout and retest of the channel. So if we're looking here, the next candle after the rejection of the channel right here would open us up at about, if you got right at open, I think it's about 35, 33 for the open on this candle. So we would plug in 35, 33 minus the current price times a percentage. In this case, we're going to use 5% just for fun. And that would give us 33.56 for a stop loss. So if we were to go and plot that out on the chart, just so we had a visual reference, let's see how close we can get. 33.55. That's pretty good. I'm going to put a trend line there, a horizontal trend line. And what you could do with this is 2 things. One, most brokers allow you to set a stop loss at a predetermined price. So if you were doing AVAX and you were selling or doing contracts on a certain exchange, you could set that predefined price on your exchange as your stop loss. Otherwise, what you could do as well is you could add an alert. And if you added an alert, you could just put whatever you want here. It could just be stop loss, nothing fancy. I mean, if you have multiple stop losses, you might want to be a little bit more defined with your naming conventions. But as you can see, if we were to have set this stop loss, we protected ourselves from further downside, giving us that ability to live to trade another day, protecting our capital, and being able to move on to the next trade. I always highly recommend, though, when you do have losing trades, to go back and review them to see maybe what went wrong or how you could improve for the future. But having a stop loss in place here can clearly save you from further downside and further loss of your capital. The second method that I want to go over is a volatility-based stop loss. We do this by utilizing the average true range, or ATR indicator. And this indicator basically plots out the deviations from the average price over a given period of time. In this case, it's 14 period. And you take, for a long stop loss, the current price minus the ATR at whatever your entry candle is times an ATR multiplier. And most of the time, the multipliers are like 1, 1.5, 2, 3. And this is basically how you're calculating like how many deviations from the current price are you willing to go based off of that ATR number. And it would be the same but inverse again for the short stop, which you would add that to the price. So let's use the same exact example of a breakout and then hopeful, onward movement of the price on AVAX after breaking out and retracing to this channel. So at the candle that we had discussed previously, the ATR is roughly 0.87. 86, we're going to use 87. And if you were to take the current price of 35.33 minus the ATR times a multiplier of 2, so 0.87 times 2, so that's saying that we're willing to go to 87 cents twice outside of the price is current price. That's like our comfortability of being able of the loss, right? So that value would give us 33.59, which would again be not too far off from where we were on the percentage based one. But again, this all is dependent on how much risk you're willing to take. So is your multiplier 3? Is your multiplier 2? Is it 1? That is for you to decide. But this is an effective way to set a stop loss that also takes into account market volatility, which is very useful in. For the next methodology of implementing stop losses, I want to cover trailing stop losses. Now, trailing stop losses are a really great tool if you're already in a position, price is moving favorably in the direction that you want it to go. So if you're going long, price is moving up. If you're going short, price is moving down. But if you can implement some kind of stop loss, some kind of cut point that trails along with the price, you can still maximize your profits, but also minimize that downside and not let the price revert all the way back up to your original stop loss that could be way up here when you're already way down here. So let's use AVAX again as an example, but we're going to move back in time a little bit and say we are in the channel. What you could do is implement some kind of stop loss like a SMA or a EMA or an exponential moving average or a smooth moving average at whatever your desired length is. And that length could be based off of how volatile you think things are. You might want it to be a little bit of a shorter length on the SMA if things are a little bit more volatile. Or if you want room to breathe, you make it a larger number. In this case, we're using 50. And you'd look for a break and close above the 50 EMA. So let's say we see a lower high here and bounce off this channel that we're in, and you entered a position here and you have your stop loss in place at a predefined point above. But once this price starts moving well away, you could take partial profits. But what if you want it to run further, but you still want to protect the overall profits that you're gaining? You could put this I have an SMA on here, or a SMMA on here of 50 length, and you look for like a break and close above that to close out your position. So again, you could come in here, you could add an alert, you could have a crossing up, and then enter in your stop loss name here. And that would attach an alert here that would allow you to be able to exit your position if the price were to break and close above. Another indicator that could be useful for this is a super trend indicator, and the super trend indicator is an ATR based indicator that, so we're going back to volatility, and it's set at a multiplier times the ATR length, or in this case, it's called a factor. But if you can move this factor up and down, and it will move your ATR based super trend further away or closer to the price. And this you can also set an alert on. Another good one that some traders use is PSAR, which is parabolic stop and reverse. All three of these indicators, or any trend following indicator, can be really useful in setting a trailing stop loss, and I highly recommend them if the price is moving away from your original entry point and it's going in a favorable direction. The final methodology that I want to show you for setting a stop loss is by using another indicator. I'm a big fan of indicators. They have lots of different use cases, but in this case, we are going to use a Donchian channel. And what a Donchian channel is an indicator that produces three lines. The first one being this one, which is the highest high over a given period. And the second one is the lowest low, this lower boundary over a given period, and then the difference between them. And the given period in this circumstance is 50. Standardly, it comes as a period of 20, but I'm going to expand it just a little bit because that allows us to give that breathing room, maybe look at more defined peaks. And we're going to look at this same trade setup that we had before. Now, obviously, you want to confirm with other indicators or whatever your personal setup may be. But in this circumstance, we're just going to say that we did the research and we're going to enter a short right here. We can go and we can add an alert to the Donchian channel. And if I move this over, we're going to set the alert at the upper boundary, which is this boundary, and we are going to move it just outside of the price or the boundary that we're at. So you can see that it's just above. And the idea here is that if the price comes up to this point, this could be a resistance zone. And we can actually see that the price has reacted off of this area before if we move backward in time a little bit. So this is actually a really great spot to put a stop loss at, because if the price has reacted here, there's stiff resistance here. Sellers are in control at this level right now, and the buyers don't have the gumption to take it above. So it's more likely that we'll be protected here because the price could continue back on downward if it were to retrace up to this point. So we have protected our capital and our trade. And now that we are in the trade and we see that the trade is moving in the direction that we desired it to go, which was down, we could follow the upper trend line and use this as a kind of pseudo trailing stop loss, because you can't directly set an alert, or you can't set two alerts on the same indicator. You have your first one here, and there isn't one on the Donchian channel indicator as written, I believe, to set a stop loss based off the movement of the line. So you could enter this trade and you could be in it all the way up until the price starts pushing the boundaries of the upper Donchian again. So this is a very effective way to get kind of the best of both worlds as far as a trailing stop loss and a firm stop loss. And it is at a definable point where price has reacted before. So it gives you a little bit more clarity on how the price could react at this point in the future. That's a wrap. You now have a firm understanding of the what, the why, and the how of stop losses. And you also understand that mastering stop losses is essential for any trading strategy. Though it takes practice to be able to define points where these are most applicable or where your stop losses should be placed, is that's something you got to learn as you go. It's based off of your risk tolerance and other factors, but if you practice, you will get it. And by setting realistic stop losses using various techniques that we discussed in this video, you can minimize your losses, stay disciplined, and pave the way for your own long-term success and betterment in living to trade another day. We hope you enjoyed this video, and if you would be so kind, please like and subscribe so that you don't miss out on any of our future content. We hope you enjoyed this, and happy trading.